Hello, this is Eric with EliteOptionsTraining.com. Wanted to create a quick video to explain break-even analysis. So what is break-even analysis? It's the price at which an investor has neither lost money on an investment nor made a profit. Or said another way, it's the price at which the option has enough intrinsic value to cover the premium the investor paid for the option and profit is still zero. So let's walk through an example just to make this concept clear. We'll look at ABC stock currently trading $25 in the market, and we're going to purchase the ABC $25 call for 50 cents. At what price does the investor start making money? Well, with stock price sitting at $25, we paid 50 cents for the option, and we know that call options increase in value as the market goes up in price. That means our break-even price is going to be the stock price plus the call option premium, what we paid for that option, added together. So $25 plus 50 cents equals $25.50. And here's a graph of what the payoff looks like. You'll notice that before, with stock values less than the strike, less than $25, you'll see a loss in the amount of what we paid for the option. That's because when you buy an option, the most you can lose is the premium you paid for that option. Between $25 and $25.50, you have that option beginning to gain some intrinsic value. At $25.50, we have already gained enough intrinsic value on the stock move to cover our 50 cents per share that we paid for the option, and now that option will continue to grow as the stock price increases. So at $25.50, the stock has risen enough to offset the price the investor paid for the call option. The investor will continue to profit as the stock rises higher than $25.50. Now, would the break-even price change if the investor sold the option rather than buying it? The answer is no. The break-even price would be the same. The option seller would simply begin to lose money as the price rose beyond the break-even price. And here's a payoff of what selling the ABC 25 call will look like. Notice that below the $25 strike price, the seller of that option has made 50 cents. As the seller of the option, the most you make is what you sold that option for, the premium you received. And just as in the other example, once stock price gets to $25.50, the seller begins to lose additional money as the stock continues to rise. Now let's look at an example using put options. For this example, we're going to look at XYZ stock currently trading at $25 in the market. We will purchase the XYZ 25 put for 50 cents. At what price does the investor start making money? Well, the XYZ stock price is $25. Once again, we paid 50 cents for the option. And with put options, they increase in value as the market goes down in price. So our break-even price will be the stock price, which is $25, minus the premium we paid for that put option, which is 50 cents, to give us a break-even price of $24.50. And here's a a payoff graph showing where that break-even point would be. So if you notice, with the stock trading higher than $25 per share, the investor that buys this option, his maximum loss is only the 50 cents that was paid for the option. Between 25 cents and $24.50, between $25 and $24.50, that put option begins to gain enough intrinsic value to cover the cost that the investor paid for the option. And just as in the call option example, once it passes the break-even point, it continues to increase in value. So at $24.50, the stock has fallen enough to offset the price the investor paid for the put option. The investor will continue to profit as the stock falls lower than $24.50. Just as in the call option example, the break-even price will not change based on whether the investor bought or sold the put. The put option seller would simply begin to lose money as the price fell below the break-even price. And here's a payoff example of that. So as you can see, the seller is keeping the 50 cents premium for every strike price higher than, or stock price higher than the $25 strike. But once that break-even price is reached, the seller will begin to lose money as the stock continues to fall. So thank you very much for watching our video on break-even analysis. If you have any questions, feel free to email us at options@eliteoptionstraining.com.